Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, January 6, 2023. It's 11:03 Eastern Time. I'm starting the video, and we're going to start out with the micro and then go to the macro. I'm not going to go down super short term. I just wanted to start with the 60-minute charts. That's really where my focus has been lately. I've been harping on these, what I call Christmas trading ranges, really started about mid-December here, and we're still in them. Like I said, on the Qs, we've had two little whipsaws, actually three now, if you count yesterday. But again, it was barely below, and more importantly, the S&P 500 or the small caps. They were not below their range. In fact, they were well within their ranges. So anyways, these are going to get resolved one way or the other. I still favor, I'm leaning towards the upside resolution, and it's simple. This isn't rocket science. Obviously, statistically, the longer these ranges go, the better chance they have of breaking out. Nothing goes on forever, so sooner or later we'll break. And the fact that we've had this recent whipsaw, and most importantly, coupled with the recent divergent lows, bullish developments, that's what I'm favoring. The fangs have been heavy. I watched the action this morning. The market moved up big. We had some the employment numbers, more so payroll data, showing that wage inflation may not be much of an issue. At least that's one data point. We'll see. I know the Fed's not going to react on one data point, but that was the market shot up, futures shot up, they shot down, and keep in mind, in a volatile moving market, I'm not going to post updates on 5 and 10-minute charts and every little play-by-play on front page posts. I don't want to inundate your inbox with that, nor do I imagine the majority of the subscribers the right side of the chart aren't active traders. But with that being said, I do make a point, and I got out. I'll use the comment sections below the recent posts, and I gave you a 10-minute chart. Here, let me show you that real quick. I said I'd go down to the 60s, but let's zoom down here. I got this one out to you right when we back tested. So this is what I noticed this morning. We had a bullish falling wedge pattern, and it's beyond coincidence how often the technicals and the fundamentals align. So there was the report came this morning right here. The futures popped, and that was also a breakout of the bullish falling wedge. They shot right up here. Already had that level on the chart from before. I think I showed you this one yesterday. 10,952 and change. If you can see closely, we hit that almost to the button. Little momentum overshoot, came back down, hit that resistance level, came down, and then made a perfect back test. That's where I got that post out to you, and again, it was in the comments section. So then when I did the update on natural gas, I included it for those, and that's it. So that was an objective long entry. When you have a bullish falling wedge pattern, you have two objective long entries on the breakout or on a back test if you get that. So that's that. And then just going back to the 60-minute chart of QQQ, again, the fact that we've had the trading rings is getting very long in the tooth, and we had a false breakdown that tends to, as I said before, suck in a lot of short sellers and also shake out weekend long. So if we can power up, I thought we'd have a good, and I did. I thought we had a good chance of breaking out there, but we didn't. We never had the buy signal. So bottom line is we still need to take out 267.36 on QQQ. Based on what I'm seeing, I think it's coming now. I think we've seen the early, New Year's dump, the last kind of weekends shaking out. I think it's institutional selling too. There's been increasing narrative that we're heading into recession, and growth funds, mutual funds, pension plans, even hedge funds are going to dump what they have a lot of, and especially growth stocks. When if you have a lot of growth stocks, great in a growth environment, no matter what the PEs are. But when you have high P ratios, and all of a sudden these growth rates start contracting, you're seeing layoffs across the board in the tech sector, and so I think it's just been a lot of dumping. But I'm going to show you some things here when we get to long-term charts that I think are pretty compelling. Either way, so that's QQQ, not there yet, getting close. SPY, the S&P 500, very well-defined range, only really one whipsaw there, but again, that would have been a breakdown that I don't think you should have took because you had positive divergence. If anything, you look for a divergent low, you go long, especially on the recovery back into the range. And then you also have, as I mentioned yesterday, a nice clean uptrend line. And so we haven't had any sell signals yet. We need to see all these indexes break down, particularly SPY, QQQ. Small caps will follow their big brothers. The large caps once we get the breakout. So that's it. And again, based on the nature of this, if we do get the upside breakout, and I covered it in case it happens to be a false, a breakout, you want to take it on face value, take it, and then just set your stops somewhere, whatever is good for you in the middle of the range. You could set at the bottom of the range if you're looking for more upside. When I get to these long-term charts in a second, it's I think a case can be made. You know me, been all out bearish since the end of last year, calling for the bear market, trading the bear market. Don't think the bear market's over, but I'm going to show you some charts that are may make a case where you could see a decent bounce in the market leaders and of course the stock market. IWM, small caps, same thing, clean range, a lot of compression here, threatening to break out, but again, that's a breakout. If you want to be safe, you want to see the large caps break out as well before you go too heavy into the small caps. It's just my opinion. All right, let's go to the long-term charts now. That's 60 minutes. That's these 60-minute charts help guide us where we might be going in the coming days to possibly the coming weeks. And then you go all the way out to the long-term weekly charts, and this paints the bigger picture. All right, this is I have many different boards, but I'm going to show you some simple, clean boards with just not all the divergences and all the minor trend lines, just the big stuff here. And this is QQQ. And I don't know where everyone else is on this. I know to me, this has been one large bull market. COVID, although we've had corrections along the way, even in fact the bear market that now everyone agrees 2022 is a bear market. But when you look from a long-term perspective, if you want to take that route, this is our primary bull market uptrend line. This is when the bull market began. In the NASDAQ 100, technically speaking, it was November of 2008. Every other index, Dow, S&P, small, mid caps, all of them, they bottom in March 09. So really about a double bottom there. And this is the we'll call it the Fed, the great Fed bull market, whatever you want to call it. That's when their zero interest rate policy, quantitative easing, all that stuff kicked in several rounds since, and they've just refused to, they overjuiced the market and the economy. But with that being said, you can see that's the you can draw a pretty clean uptrend line. You have an almost tag there, you have a perfect tag right there, and of course right here. So if you look at it from this perspective, that's we're at long-term primary bull market uptrend line support. Now I can sit here all day long, and I've done that a lot recently, making the case that we're in a bear market. The bear market's not close to over. Look at the 200-day / 40-week moving averages. Look at all my other trend indicators, and they're all saying bear market, and you want to short rallies back to that. But with that being said, here's support. Even if you come back to just the last few years, COVID lows, the previous low in the bear market, and this one here, you have those three distinct reactions, and of course the reactions all the way back in the 07, 08 as well. So, and again, positive divert. I could sit here all day long, and I do that. I tell you the bullish developments, I tell you the bearish ones, and not to confuse you, not to give wishy-washy analysis. I always tell you where I think things are going, but I would be remiss not to point out, all the good and the bad and the ugly. So there it is. QQQ, NASDAQ 100 at long-term support. Let's not overthink it. I didn't even have it planned to queue it up. Let me put up SPY and see if I have a trend line. I've got a lot of boards here, fibs. Let me just go back to this one right here. Let me clean out some of these lines, clean out these fibs, and let's just for fun see what we have here if we draw a trend line. See, not as clear on the S&P 500. Come and capture that. COVID, you broke it. If I come down to the COVID, so that's why I didn't have a primary uptrend line on the S&P, at least not on this time frame. That would probably be something more along the lines right there, because you can come in and capture this reaction low, that one in 2018, and then a little punch through on COVID. But again, I don't force things, so that's why I didn't have a trend line on SPY. But what I wanted to do, and I'll conclude the video with this, is just show you the market leaders. So here's Apple. I have a trend line coming off 2003 right there. That's a long ways back. And it's a very long-term bull market uptrend line. The stock has been in, it's one of the great bull markets for any stocks. Great growth company, great story. One that I think will come to an end. I do think this trend line is, I think it's inevitable at this point, or imminent, I should say, that it is broken. Imminent, not necessarily in days, possibly, but more likely weeks or months, 2023. But do we get a bounce first? So what I was highlighting there for you is a big negative divergence going into the highs, but also, a lot of clean reactions there from 2003, and then you zoom in tighter. That's 1 back there, 2, almost 3 there, 4, and we're on it now. So maybe the buyers step in here, maybe not. Just wanted to point that out, that's the most important company in the NASDAQ 100 and the S&P 500 because it's the largest weighted. Microsoft, I have a lot of different boards, but this is one trend line. Not crazy about it, it's got enough reaction. It's got the minimum amount, really. We'd have, 3 is to me the minimum amount because any 2 points can be connected at random. So going back to this, I'm just going to zoom in. That trend line comes back to 2015, 1, 2. And then recently 3, that helped to validate it, and we're back there already. That's also a sign of weakness when you hit and then you're back to it so soon. Usually when you hit primary uptrend lines, you're off to the races, the next big leg up, and it's months if not years before you revisit it again. But again, I wanted to show you that, and you can hear it in my voice, kind of a meh trend line. This one's a little bit more significant, and this is where I think Microsoft goes before all said and done, and maybe sooner than later. Look, we take out the recent lows, there's a lot of hot air, and then we could take out all these support levels I'm showing you in this video. But so, I think Microsoft still has a long ways down before the bear market's over, and to me it's just a question, is it going to be sooner or later? So there's Microsoft. Alphabet. Alphabet came public back here in 2004. That was Google, Google's parent company. There's the trend lines, pretty clean. We don't have the long-term price history that we do in Apple and some of the other ones, but you've got enough reactions, and we're on it. We're on trend line support. So, we're below all the moving averages, all the trend indicators say, hey, bear market. But again, are we going to get even a bounce, even a reflexive bounce on this time frame is probably going to be double digits. So that's what I'm looking at here. And if we had solid weekly closes below all these candlesticks, well, that's going to be bearish and open the door for a much deeper drop in the market, in my opinion. So there's another one at trendline support, and that's the point of this video, just showing you. Amazon, it's cracking it right now in the weekly. This is what happens on this charting platform. Bugs the heck out of me, but when a stock splits, the trend lines don't move. They stay where they were at the old price, and you're going to move them around. So just ignore that. Just an old board. But I updated the uptrend line. You can see it's a clean uptrend line since the stock came public back in '97. A lot of nice reactions along the way. That was a near reaction there, but these are perfect reactions, and we're back to it right now. Now we're also just a hair below it. And there's a weekly chart, and I'm going to say that we're below it. So not great, and again, I'm not making a strong case to be long here, just pointing this out that if the market can hold these lows, break above the recent trading ranges, then we could get a rally that could even exceed the 5 to 10% or so that I'm currently looking for. So that's Amazon. We already covered the other share class of Alphabet. There's the other chart, GOG. We covered GOGL, and then I think that's it. Let me see. Did I want to? Yeah, that's all. Those are the big ones I wanted to cover. Tesla's too new. This is the primary uptrend line. This is where Tesla's probably coming back to before this bear market's all said and done. I'd put a high degree of confidence. That's a whole lot lower, but it may take a while to get there. And Meta, again, Meta's a relatively new company, 2012. So, and it already took out its long-term trend line. I think you can see it there. Here, I'll draw it for you. This is the primary uptrend line that I had on Meta, and it's long since undercut that. That was a little brief whipsaw down there when COVID hit, but a lot of clean reactions. And see, this one gave up the ghost. So, we're in a bear market. They've been taking out the market leaders one by one, shooting them. The last one to really truly buckle is Apple, and that's when this bear market gets some traction. It'll be when Apple finally gives up the ghost. And well, you can see I have a lot of different boards. And there's that same uptrend line I showed you earlier. So we're at uptrend line support in Apple, a little, and just below it, by the way, if they undercut it, I've got a support zone right there as well. But once all that goes, my next target's 105.50, and then my current, and I've maintained this, I think, since over last year. Covered this many times. My current final long-term target is about 82, 83, and this primary uptrend line. Again, that's the primary uptrend line. Apple roll back here. But again, I think this bear market's going to be a lot different from those in past decades. I think it's going to be a long, very long secular bear market with a lot of bull market rallies within it, smaller bull markets, plenty of trading opportunities. I don't think it's going to mirror the the fast, relatively quick 18-month bull markets we saw in 2007 to 2009, and from 2000 back to 2002. Those were our last true bear markets, in my opinion. And this one, like I said, I think will play out a little bit slower and take some time to get down there. All right, I'm going to end it here. And again, that's long-term stuff, and I update that from time to time. Very near term, watch the levels. One other chart I got out to you this in the post. Oh no, that's the one. Oh no, that was hold on one sec. Yeah, this is it in the comment section. That was different from the one I got out to you in the natural gas update post. I said a pop above 264.63 could be the catalyst to send the Qs back up to the top of the trading range. Let me show you that chart. This was a 5-minute chart that I posted. So you can see right here we have these two reaction highs, and here I'll get to that live chart and show you that real quick. So again, go back in if you're actively trading, check the comment sections under the recent posts, and you'll see I'm just drawing this now because now since I gave you that post, I have a little uptrend line right here which we just cracked. But so there's the 264.63 level I talked about. So I saw two reaction highs there. And on the 5-minute chart of QQQ, you had the downtrend line right here. You have positive, aka bullish divergence right there on the indicators. So I gave that to you here and said that would be a buy signal. A break of that should take the Qs up to the top of the trading range. And we took it out since then, since that update I gave you. And top of the trading range, again, remember, is on the 60-minute chart. We're close to it now. So I suspect we'll get there. And again, I suspect, it's Friday, of course. If they pop it today, great. Otherwise, they may keep us guessing because it is Friday. I don't know what we'll see. If we'll see some profit taken today. The Qs are up 1.6% right now. But I'm still leaning towards that upside breakout and then a rally, which, again, from where we're at right now, max bounce target about 280 at this point in time, 5% there. But certainly the potential for more in select names, and as well as potentially more in the in the Nasdaq 100. We'll see. If and when we even get the darn breakout, at that point I'll dig into the charts a little deeper and see whether or not to extend or even truncate any of these targets. In other words, anything shy of 280. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.